Happy Monday, everybody. I hope you had a good weekend. Today is September 9th, 2024, and this is your Monday market update. As weeks go, this one that's coming up is a pretty one-dimensional, maybe two-dimensional inflation and, of course, jobs. We're going to preview this coming week in a moment. Let's talk about last week first. Only 4 days to report, so we'll see what we get. Monday, as we know, markets were closed for the Labor Day holiday. As markets opened on Tuesday, there was a little U.S. data to respond to, but bring in China and Europe eco data better than feared, but still contractionary, and an underwhelming ISM manufacturing for here in the U.S. The beginning of the month positioning was probably the big mover ahead of the jobs number, and sprinkle in the rising tensions in the Middle East. Markets started in the red, and the methodical sell-off was relentless all day long. Oil prices did drop sharply regardless of the Middle East, with WTI futures falling 4.33%, their lowest since January, as demand concerns from China and progress in Libya's oil production weighed on the markets. By the end of the day, the Dow was down 1.5%, S&P down over 2%. Remember the time I told you how long it had been since a 2% move? Now, the NASDAQ, we'll see what we're doing now. And the NASDAQ down 3.25%. More of the same on Wednesday, but markets did try to stabilize. And after a pretty ugly day, they finished slightly lower. More weak economic data, including from China. The Eurozone also weighed on markets. For jobs, the first batch of jobs news, a softer than expected JOLTS report, showed a drop in job openings, contributing to the global growth concerns that we're talking about continuing. Although stocks briefly rallied after the JOLTS release, markets did roll back over. The gains could not be sustained, and the market finished the day near its lows. Oil continued to go down, with WTI crude falling another 2%, extending its weekly losses to 6%. Declines continue to be driven by weak global growth data, concerns over China, and a soft U.S. labor market report. The Dow was slightly higher on the day, very slightly, less than 0.1%, but the only green arrow of the three. The S&P was down less than 0.25%. The NASDAQ was down 0.33%. ADP numbers were the labor report du jour, and with a disappointing number, but as an offset, the jobless claims numbers supported Fed cuts, and the markets did try to stabilize. ISM services helped gains a bit, and that was short-lived. Stocks did roll over when the ISM data was reviewed in detail, and that darn stagflation word came up again. Remember, Jay Powell he said a few months ago, I don't see the stag or the inflation, so we'll see what's going on now. Focus turned to the upcoming Friday data, and markets reverted to the flow of things down. Dow was down 0.5%, S&P down 1/3%. The NASDAQ was green, and that was the green one for the day, up 0.25%. All eyes on labor numbers on Friday, and the numbers were below estimates, and there were revisions on the past few months, pretty much wiping away much of the job gains we've seen. Wage inflation was hot also. This was not a good report on the economy or health of the labor markets, but markets had sort of expected this. We got a pretty flat to slightly higher open. Then we waited. I hate to admit it, but the market was actually waiting for the Fed heads to put their heads out, and Williams was the first, did not toe the proper line, and stocks broke to the downside. Waller also spoke, but his line was a little bit more for the cuts, but seemed like more like the bad market book had come out. That was the good news is bad and the bad news is bad. More bad news in the semiconductor space, with Broadcom earnings in line. That took more of the semis and most of the tech down with it. Like I said, everything out there was being interpreted as bad. Also on the bad news front, that meme trader was back, and social media posts moved a few specific stocks. This is the sign of speculation, to say the least. Fred head Goolsbee did try to quiet things with the idea that the Fed's job right now is not to make things worse. Markets got ugly into the close and closed near the lows. For Friday, the Dow was down 1%, S&P down 1.75%, and the NASDAQ was down another 2.5%. For the ugly week, the Dow was down just under 3%. The S&P with the worst week since March of 2023, down 4.33%. And the NASDAQ with the worst week since 2022, down just under 6% on the week. So for the idea of how the year is going, best performing sectors, boring utilities. Not so boring, up 22% year to date. So this week, someone said to me this morning, will it be better this week? It can't be worse. And I shushed them on that. We are off to a pretty nice bounce starting out today. We don't know what the day or the week will bring. This week will be light on quantity, but heavy on quality. Of course, for the political ones, we have the debate. I've said it before. While this election may be very important to policy in the near term, wait and see on that. History tells us that the long term is not really so affected. Are these times truly different? We'll have to see. We will get inflation numbers in the way of CPI and PPI, and although the Fed seems to think the inflation is tamed, any surprise here will raise questions. The weekly jobless claims on Thursday will be the one to watch. We will also see University of Michigan survey on consumer sentiment and inflation expectations. But again, CPI and PPI and the jobless claims, those will be the one to watch. Only other big item of that matters, if you care about it, is the large companies out there by market cap. Apple is revealing the new toys, and we'll see if they can spark anything new. For now, here's a good read on what has happened in the last week, short week, and what to watch for this coming week. Come back on Friday for the planning update and check out the new blog on the website about college savings. Finally, watch for some special videos coming soon. Have a great week.